Did you know that debt can save your company some cash? What? How is that possible? Let's talk about that in this video. Welcome to My Finance Teacher. In a recent video, we talked about capital structure, which is a split of total assets between equity and debt. And here we extend a little that discussion into the tax shield that the debt can generate. This tax shield actually protects your cash flow from some of the taxation. Let's see how that happens. So let's have a look at this example where we try to illustrate debt and how it can generate a tax shield for your cash flow using an example of a couple of firms. Let's say mostly these two firms are very similar, operating in a similar type of business, or perhaps these are two scenarios for the same firm, where in one scenario the firm does take some debt, and in another scenario the firm doesn't have any debts, but everything else is the same. So let's have a look at firm A with, let's say, 800,000 in debts. Tax rate is 30%. Let's say the firm has 200,000 shares outstanding at the share price of, let's say, $10, which gives the market value of the total assets of 2.8 million. That's the total value of equity, 2 million, and 800,000 in debt, 2.8 million. And let's say the interest that the firm pays on the debt to keep it rolling is, let's say, 8%. A similar scenario or a similar firm, everything else is mostly the same except for zero debt, taxes are the same. Number of shares is 280,000 shares at, well, let's say the same market price per share, which gives the same total assets, 2.8 million, fully funded by the equity of the company with no debts. Now let's say the operating performance of both of these firms, both of these scenarios, is also similar until you come to look at the debt. So let's have a look at the income statements for both of the firms. Revenue, the same at 460,000, cost of goods sold at 290,000, fixed costs at 40,000, and let's say same depreciation, $30,000. Which actually brings us to the same value of earnings before interest and tax for both of the firms, which is of course the difference between revenue and all the other costs mentioned above. Copy this and we get 100,000 in EBIT for both firms. Now firm A pays an interest of 8% on 800,000 of its debt, which gives you $64,000 in interest payments. Firm B doesn't pay any interest payments. So earnings before tax after deducting interest is actually different for both firms. EBIT minus interest gives me earnings before tax, and we apply the tax rate of 30% to the EBIT to find the actual tax payment, which is under 11,000 for firm A, and it's at 30,000 for firm B. That's where actually the tax shield comes from. Net income is the difference between EBIT and the tax payment, which is of course smaller for the company with the debt. As you see, profits for the company with debt is much less than half of the profits for the company without debt. But if you look at the earnings per share, that's net income divided by number of shares outstanding, this huge difference in the profitability between the two firms diminishes a little bit. Simply looking at profits, we see that the company with the debt makes much less than half of the profits of the other company. But looking at the earnings per share, that's the returns to the shareholders, we see that the earnings per share for the company with debt is actually slightly more than half of the earnings per share for the company without debt. And that is due to the fact that the company without debt would have to have greater number of shares outstanding to achieve the same amount of total assets. And to finally look at the actual value for the tax shield, we need to look at the operating cash flow, which is, of course, earnings before interest and tax, plus any sort of not out-of-pocket costs, which in this case is depreciation, minus the tax payment, which gives you over 119,000 for the company with debt, and much less than that for the company without debt. And that is where we actually see the tax shield. The extra debt protects some of the company's cash flow from the taxes. And in our case, the tax shield is the difference between these two scenarios with and without debt, which is $19,200, which is equal to the tax rate multiplied by the interest that is paid on the debt, multiplied by the value of that debt. And in our case, that's equal to 30% multiplied by 8% multiplied by 800,000, which is the value of the debt, giving us 19,200. So that is how we calculate the value of the tax shield for a given year. And if this tax shield persists over the years, if let's say the company simply rolls over this debt indefinitely by simply paying the annual interest of 8%, then you might try to calculate the added value of the tax shield going indefinitely into the future. So let's have a look at the present value of that tax shield, which perhaps, maybe in perpetuity, as long as the firm survives, will provide an extra cash flow of $19,200. And as you know, you can calculate the value of perpetuity by dividing this annual cash flow by the ongoing market interest rate, which gives you 240,000 extra in value of all of the future tax shields, which again was simply a ratio of the tax shield amount over the interest rate. I hope this helps. If you like the content, hit the like button, share the video with your friends, and of course, good luck on your tests.